I will start from up here, and then I'm going to move down where everybody's sitting so we can Suzanne hear you can hear me better. But thank you for having me today. This is a topic that has really been gaining a lot of traction in the United States, and I'll share some of that with you as we go through this. I was telling Lori that as I've gone to conferences, and I speak a lot of conferences around the country, I remember walking into an ASF conference. They had a breakout session on impact investing, and I was about 2 minutes late to the room, and I walked in, there was one empty seat. There were probably 150 people in there. Every subsequent conference I've gone to, the room is always packed when we talk about impact investing. So it's growing a lot in recognition in the United States. I think there have been some things that have happened that are accelerating that, but we are seeing much more interest in this today than we did before, and that's because some of the myths about impact investing are being blown up. So I'll talk a little bit about that, what it is, the different approaches to it, and some of the types of investments that are made, and what how organizations are moving into this area. Very few are starting from scratch or getting rid of all their investments and starting all over again. They're kind of moving into it. So I'll talk a bit about that and some facts and what our impact is. Some of these slides were created by my firm. It's not an attempt for this to be a commercial with Morgan Stanley, and I'll answer any questions you have. Before I start, is there anything you would like me to cover that I haven't talked about? Okay, then we'll go, and please feel free to stop me and ask questions along the way.
I know we have one question is sort of the poll about doing social impact investing locally and saying it's absolutely for, this like Arizona versus doing impact investing nationally and or internationally, and what that sort of tug and pull is with that you've seen with other foundations.
Okay, we'll talk about that. And Kelly asked me, by the way, if I knew of any foundations in the Valley that were kind of pioneers in this. And I asked around a bit and haven't really come up with any. So if you know of any, please let me know about them, and maybe I could have some conversations with them to just see what's going on in the Valley. I know a number throughout the Midwest and in Texas that have moved in this direction, but I will talk about program-related investments, which is partially what Suzanne's talking about. So with that, I'm going to move up down where kind of all of you are, so we can talk a little bit better and share some thoughts with you.
Will John be able to still see you?
So right now, John is just seeing the presentation.
Okay. Yeah, that's fine.
Thank you. So let me talk a bit about the terminology and some of the institutional trends. The question I get at conferences all the time is, well, if we do this, what about our fiduciary responsibility? Don't we have a responsibility to make sure these investments produce as much as they can? Maybe I'll talk from here. And so we'll talk about that. There was a recent DOL ruling that may have clarified some of that. And then how do you get started and what can a portfolio look like? And then we'll talk about some of the issues Suzanne brought up. I was telling Lori that over my career, it became about obvious in the 1990s that the people I enjoyed working with most were people who sat on foundation and association boards because they were all there to make their community, the world, a better place. And they're all people who want to give back, and that's the reason we love working with this organization, whose offices we're sitting in. They're just terrific people who really care about what they're doing and the impact they have in the community. So it's logical that those types of people would say, well, we've got investments, and the purpose of the investments is to generate income that we can use to fund programs. But over time, let's take a look at those investments and see if we could have those investments target some things that would also make the world a better place. Let's see if we can interact with companies and through shareholder resolutions and get them to change the way that they run their company. Get them to change the diversity of their board. Do they have women? Do they have minorities on the board? Get them to talk and think about, do they recycle the paper and plastic that their organization uses on an ongoing basis? And a while ago, the UN came out with their principles of responsible investing. They had a large number of organizations respond to that. And we're seeing today a lot of companies really pay attention to those things, and there are a lot of signatories to that. And because of the fact that they're trying to be sustainable, there's a feeling out there that those companies will do better over a period of time. They'll have less risk from outside events that will take place if they're really being responsible and taking care of those things. And I know that our firm has a questionnaire every year that we have to fill out about how many hours do we give to our community, how many volunteer hours do we do. They talk a lot about diversity, and I think we're seeing more companies do that. And I think that we're seeing a lot of asset managers today interact with companies in a much more positive fashion. They'll file shareholder resolutions where they say it's not necessary that those resolutions actually get to a vote at the annual meeting, because in many cases we've sat down with management beforehand and they said, you know what, we don't really need to put this to a vote. This is something we should be doing anyway. So they're really starting to have a great impact. So what we're talking about is kind of integrating your financial goals with your impact goals in the community, and there are some ways you can do that in your community. I'll tell you a little bit more about, but we're trying to make positive social change in the world using our investments as a tool. You may recall that in the 1990s, the Catholic Church took a very strong stand about apartheid in South Africa, and it resulted in literally a ban of companies started not investing in South Africa. There was a cutoff of flow of capital to that country, and kind of after being crushed under the weight of that for about a decade, they ended apartheid, and a lot of that really had to do with the social and financial pressure that was created by investors in interacting with them. This is not a new tradition. In 1898, the Quakers said, we will not invest in any companies that are involved. I don't know what the investment options were in 1898. They're certainly fewer than today. Any companies that make weapons, they're very violent, alcohol or tobacco. So it started a long time ago, and it's kind of evolved through the world. In 1984, the U.S. Foundation for Sustainable Investing was founded. They have an industry association to a major conference every year. Bloomberg in 2009 started adding information in their financial screens about environmental and social and governance practices of companies. In 2013, we launched our Institute for Sustainable Investing, and in 2012, we rolled out a platform where we actually have research analysts that do research on money managers that manage money for environmental, social, and governance criteria, Catholic values, Baptist values, a lot of different things, so people can align their investments with, organizations can align their investments with their mission. And then in about 2012, there were about $3.7 trillion invested this way in the United States, and by 2014, that number had gone to $6.5 trillion. So we're seeing a lot of movement in that direction by companies. Now, by investors. In the 1970s, it was very common, and we always had the technology that when we set up a relationship with a client, if it was a healthcare client, for instance, a hospital or an organization like Vitalis, we could say, it's really kind of cross purposes for us to invest in companies that manufacture and sell tobacco, alcohol perhaps. Catholic organizations were really front runners in this, saying, we do not want to invest in companies that make money from birth control or abortion. And so we had the ability to put those types of screens on portfolio. So even if an asset manager came in and tried to buy one of those companies, it would prohibit them from doing that. So we've had that type of alignment for a long time. It was really exclusionary. We just don't think these things are the types of things that we want to be involved. And then in the 1990s, it got to be a little more positive, and maybe we should seek out companies that were in the healthcare business that are really making some advances in healthcare that might help our community and be consistent with what we're doing. And then I think since the early 2000s, we've seen a lot of asset managers start to say, this is getting to be a big deal, and we think that we should start managing portfolios in that manner. And I'll talk a little bit more about that. You can see the amount of assets under management have gone from under $1 trillion to almost $7 trillion today in the last decade. So this is a big thing. Who's doing it? Individuals. We're seeing a lot of individuals. And I think I have a slide that says there's twice as much interest among female investors about sustainable investing. Among millennials, they're about 2 times more likely to be interested in sustainable investing. Insurance companies for a long time, because they're worried about risk, have focused on companies that they believe manage risk very well, are sustainable, and do a lot of positive things. And then endowments and foundations have really been a pioneer in this, in that a lot of people, because of the way you think, have said, maybe we should look at our investments and make sure they are having a positive impact on the world. So that's where we're seeing it come from. 6% of U.S. pension funds today have made some type of impact investment in their portfolios. That number should go very dramatically over the next few years. UNPRI, when they initially brought out that their report, had 1,200 investors representing $35 trillion sign into the U.S. UN Principles for Responsible Investment. And so the question here is, are you not fulfilling your fiduciary responsibility when you do this? How do you do it? How do you put a portfolio together? And how do you find asset managers that can do this and do it well? There's some other myths. One is that, well, if we do this, and when I get these questions at conferences, it's, well, what about our fiduciary responsibility? Is it okay for the trade-off for us to make impact investments, but still okay to have less return? I mean, that's the number one question we get all the time. The fact is that Morningstar started tracking data of mutual funds that were socially responsible. And some of these have been there for a long time, the Calvert funds, the Domini funds. And they found that those funds, 64% of the time, were generally outperforming their peer group, and were doing it with less volatility. So the ability of those companies and those funds to avoid some types of risk seems to help in their performance. If you are British Petroleum and you end up paying billions of dollars in compensation, that certainly hurts your stock performance. And if you've got companies that are consciously trying to avoid those things, it should make a difference. Investing with impact is a niche area. It's something just a few people are doing. $1 in $6 today is invested that way. So you could call that a niche, but it's certainly a growing niche. And the things that are available for us to invest in are limited. Well, that's not true anymore either. There are about 925 funds that are available that invest in some manner of impact investing, whether it be Catholic values, Baptist values, or we're only buying companies that are environmentally, socially, and governance correct. And I'll talk a little bit more about that. So there are a lot of them. There's $1 trillion there before we really started these surveys and tracking these types of things. So the opportunity set is big, and it is getting bigger all of the time. 65% of investors say that they think this will become a bigger deal in the next few years. And there are a lot of things that companies are adjusting to, trying to make sure that they are conscious of climate change, water usage, recycling water, recycling paper. And the thinking is that these companies that are trying to solve some of these problems, like aging populations, health awareness, water scarcity, will do better in the future, because this is a big trend and these are problems that we're going to have to solve. So we'll see a lot of businesses and companies really turn to these types of things. A company like Tesla, for instance, who's got an all-electric car that has, reduces carbon footprint, is becoming wildly successful, particularly among millennials who, a beautiful car, but, part of the motivation there is that this is something that won't impact our climate in the future. I think this is a duplicate slide. So 71% of investors today have some consciousness of impact investing, and 80% of the money managers and asset management firms out there said the reason they are constructing these types of portfolios is they're seeing investor demand. And when that happens, more we go out and talk about these things, the more investors say, maybe this is something we should do, then there are more people who want to get in the business of managing money that way. So it's a great cycle to have. I mentioned millennials and females are more likely to take a look at this. I'm not sure what that says about us males, but maybe we should learn something.
Wow.
I think I'm on the bandwagon, but we'll see. And a lot of investors think that companies are focused on sustainability are just better companies and will do better. So, do you have to sacrifice returns? This continues to be the ongoing question. KLD is a company that evaluates companies for where their earnings come from and what their environmental, social, and governance criteria are. And on a little handout I gave you, this is a monitor that we've got in the pilot stage right now that we can run on an asset manager's portfolio. And while this one's not wildly aggressive, you'll see that these are some of the things that they look at, that KLD looks at. So years ago when we said we want to exclude companies that make more than 5% of their income from alcohol or tobacco or selling pornography or birth control, you had to have some way of evaluating what a company does and where their income comes from. So KLD is an organization that screens companies for where their earnings come from. And so when we would exclude those types of companies in an investment policy statement and on our trading desk, we had to get data from somewhere as to how do we know which companies do that. So KLD tracks all those companies. Today, the Domini Index, which was started about 1994, the name's been changed to the KLD Impact Investing Index. And so there are 400 stocks in it. It's the equivalent of our S&P 500 for the impact world. So this is a look at the KLD 400, the dark blue line, since 1990 through 2015, or through March 2016. And that index has outperformed the S&P 500 over that period of time. So there's another slide that actually breaks out the percentage return. But this kind of, confirms that case that no, you aren't giving up return. In fact, maybe those companies will do a little bit better.
And Norm, just go back on slide. How comparable are those in terms of the companies that make up those two indices? Are they in terms of size?
Cap weight?
Cap weight.
That's a good question. I think about 11% of the KLD is small and mid-cap companies. So they're generally larger companies that they do that with. I've got a breakdown on one of the slides. So, this is interesting. Kind of how do you do this? The first, go around of this was we're going to exclude companies that we don't like what they do. They're cross purposes with us. We can do that through publicly traded companies. That's fairly easy to do today with KLD's input in. And others, the second go round is, well, we want some positive companies that really pay attention to their impact on the environment, their social impact, do they have diversified board, do they have diversity within their workforce, and do they have good governance? Does their board have a lot of outside directors, or are they all inside people? And these are things that we read about in the Wall Street Journal every day, that there's some activist investor going after some company because the chairman is also the CEO and all of his friends are on the board. So they're trying to make some impact there. And then thematic exposure, we do see different types of investments. We'll invest in themes like healthcare and other things. And then finally, there's some very direct impact investments where they're trying to solve some very specific problems. And if you flip to the last 2 pages of this, this is an example of a private equity fund that is trying to get financial returns, and they've done that successfully in their prior private equity funds. 2 funds that they've actually invested in. So the fund invests in funds specifically in other parts that invest in other countries. The first one investment they made was an Indian education fund that is educating Indians in small and mid-sized communities in India. Now, in India, if you are a very, very bright kid, you can go to the Indian Institute of Technology or, the schools that are the equivalent of our Tech, but it's a very small slice of the population. So you're a country with massive poverty and really no access to education beyond, grade school or junior high school for a lot of people. So this company is training people. They've got 38,000 new students. They've trained 40,000 people in vocational skills. So not always academic training, but being able to perform jobs other than being a waiter or a maid at a hotel, which is a lot of these people are employed in that country. So they're having an impact in the community. The company has been very successful from a financial standpoint, and is still selling at a huge discount to other companies like that. And they believe they'll either sell it to a bigger educational company or take it public at some point. And then the next page is similar. They made an investment in an impact investing fund in Africa. The country of Nigeria literally imported all of their aluminum cans. And it's a country that drinks a lot of soft drinks and a lot of fruit drinks. So all that was being imported in. They came in and they built a factory that produced the first year 600,000 aluminum cans that they could then bottle all of these drinks. That production doubled in the first year. They're now opening a second plant and opening a third plant, and each plant employs about 300 people. So they've alleviated the problem of importing a lot of things. They're taking the revenues from selling those cans and putting them back into the community, and they're employing people in the community. So that has a huge impact. This will probably be a very successful investment of running $100 million in revenues the first year. So these are some of the types of things, but those types of things can only be done through private equity investments where you're making very direct investments. Now, Suzanne asked the question about local impact, and there's a thing called program-related investments, which are not necessarily an investment, but there's something where you may have a grantee that is doing something, and perhaps they need a loan but can't get it from traditional banking sources, and you say, we'll make that loan to you. We believe you can pay it back, and as you pay it back, that will accrue back to the foundation. It may be a break even, maybe the loan will be made at a low market interest rate, but this is, we're seeing this all over the place. Or maybe you've got an organization you really want to support, but they need a place to work, so you loan them the money to buy a building with a low rate market mortgage, and so we're seeing things like this. Out of thousands of foundations that are doing this, there are only a couple hundred doing PRIs, but it's something we are seeing take shape.
So Mary, you've in essence done that.
We've done a few.
Yeah.
We invested in, it's now called Cancer Support Community, helping them to, they had a lot of equity in this building, but needed to buy it out. So we helped them do that, and they were able to pay us back in 2 years.
But even your building,
even though, we charged, we bought a building, rehabbed it, so the foundation made an investment in our own permanent residence, and then we rent below market rate to other nonprofits.
Okay. And there's an organization in Santa Barbara that has done the same thing. A lot of nonprofits got together, bought a building.
Right.
All the nonprofits are clustered in that building, and it's been very successful.
and we've done a couple, like we did the Temple Maranatha, so a loan where we knew they were going to have income coming in, but it gave them sort of the chunk of change ahead of time. And then you were saying Flynn has done that with bio investing.
Flynn has done
I think Kelly's.
private direct investment.
Yeah.
In the bioscience.
So anyway, I think I've touched on these things. And again, here's the KLD graph, but the actual return of that index has been 10.14% annualized since 1990 versus the S&P at 9.69%. I think there's some valid argument that, well, maybe we're not giving up performance over that period of time. Now, the Department of Labor made some comments a number of years ago about impact investing that was almost negative, and it put a lot of people off. And they recently came out, Tony Perez, the current Secretary of Labor, and said, we want to clarify our position on this. We believe that impact investing, ESG investing, is something that is one of the considerations you need to make and you need to use in making financial decisions. So it's okay. Economically targeted investments are things that will have an impact in your community, and it's okay to look at those types of things too. And but fiduciaries that do these things should maintain records as to what the decision-making process was and how they came to the decisions they are. And that's something any fiduciary has to do anyway. That's why you all have an investment policy statement. You hopefully have some way to track how you made decisions, hired managers, fired managers, research on those, and then your performance evaluation every quarter is kind of an affirmation of that, all to fulfill your fiduciary responsibility. So the DOL is saying that environmental, social, and governance investing is fine. You just need to have some documentation and some logic behind it. Now, the DOL does not govern foundations, okay? That is about the Department of Labor governs pension funds. And when a pension fund does something bad, they will get sued by the Department of Labor. And that's kind of massive authority. You are responsible to your state attorney general, basically. And however, most litigation that we've seen over the years where a foundation gets sued for something, particularly breach of fiduciary responsibility, they look to ERISA law, the law that governs pension funds, to make those determinations about what was good fiduciary guidance and what wasn't. So while this doesn't really, isn't binding on you, it is the thing that people look at for.
So we worked on some draft language that Morgan Stanley has helped us get to sort of figure out and we have a really good audit and finance committee, and they've been looking at that language just to say what kind of parameters. So we've had that conversation internally, trying to figure out and then we had a really robust conversation about, so do we help at night? There was an investment that was helping African and third world countries, and then we had another investment that was helping locally. And so our board sort of had that kind of tug and pull about, is it social impact for everybody? Is it social impact here? And it might help, Norm, if you could talk about the one that we did settle on that helps in Arizona.
Right, I will do that.
Okay.
Yeah, thank you.
But we've kind of had that microcosm of the conversation and sort of the struggle, because even within our own board, there's a continuum of opinion about how we should invest.
So then how does your board feel if you can do better than market returns? It's an impact investment, but you're doing better than the market, according to that, it was 10% return. I mean, does it fit into just normal investment strategy then? Not considered an impact investment?
Some parts do. I mean, there's a continuum of impact investment out there.
Right.
And what Norm is presenting is one set of publicly traded securities, and my personal feeling on why those exceed the general market is because typically you're talking about firms that are well managed, right? And well managed firms tend to do better in the aggregate than not well managed firms. So I think what the investment community is learning is that this is a valid criteria you're looking at, not necessarily because it's impact investing, but just because it's a criteria that was probably undervalued when we were putting together portfolio. But then there's another conversation that our board had, like, for instance, like divestiture conversations. So, and I can say that when we look back at our portfolio, we have restrictions on tobacco. And I can point to clear time periods where we have significantly underperformed because of that decision. And it's a decision that we've made and we're going to stick with because of the health impact of tobacco, so we stick with that. But when you get to things like divestiture conversations, where it's particularly in oil, where it's not really health related, and certainly not, I can't draw a line between divesting in fossil fuels and the health of Arizonans, which is where our impact is. So the question is, do we jump on the bandwagon of divesting out of fossil fuels, knowing that it's going to restrict my universe of assets I can invest in? So potentially, we don't know that, potentially reduce
because it's just so diluted, right? I mean,
is it going to have, well, one, is it going to have an impact? So there's a conversation, are we making a statement or are we actually making an impact, right? Particularly with things like that. If we don't invest in fossil fuels, we're not going to become fossil free, right? I mean,
but it's a symbol and it's an expression of value.
But is that, the conversation my committee had in the board is that, look, if we are knowing we're going to reduce our return, potentially, is that something we do if it's not impacting Arizona, which is where our mission is?
Right, well, I understand.
And these things go through cycles. Clearly, if you had divested from energy about a year and a half ago, the returns probably would have been better because all the oil companies, excuse me, have been under, siege by the drop in oil prices. Now, there's only one cure for low prices, and that's low prices. As these things become very cheap, that people start using them again. And at the same time, you can say a company that produces natural gas or a pipeline that moves natural gas actually reduces the carbon footprint, because what you're seeing is a lot of these coal-fired plants around the United States are shutting down and converting to natural gas because it's very cheap. It's $1.75 a thousand cubic feet, and it has a very low carbon footprint. So, do you divest of all energy? I'm not sure. I think that clearly 50 years from now, oil will not be as important to us because we're going to find cheaper sources of alternative energy through solar, wind power, and maybe water power. And so these are long-term trends that we need to, really pay attention to. But if you divest, and I will note that one of the major Rockefeller foundations has divested of oil recently, and that's where the fortune came from.
I know.
But over the next 25 years, they're probably going to
Those grandchildren, those wild grandchildren.
the third or fourth generation is disconnected from where the oil came from. So, anyway, there's a lot of.
One other thing, though, we have a diversified portfolio of bonds, and so we have some investments that don't yield we know they're not yielding a significant return. So if in that impact investing continuum, it would fit in different places because we have a diversified portfolio, right? So what we said, in a perfect world, we would get as much return as we possibly could, and it would be a sustainable, or at least in ESG, if not a proactive investment. So, but we looked at some that had that high rate of return and then others that had lower, and we said we just simply also need to look at it in the context of that balanced portfolio. So it's a three-dimensional matrix.
And you have the ability as a foundation to not necessarily have to maximize your total portfolio return. You can make decisions.
Well, but that's been a high priority of the board. It's the higher return we have, the more we can spend in the community.
We have to evaluate, right? So this is a conversation that I've had with the board on an individual basis and on a broader basis, and that is, if you want to look at the mission of a foundation, right, it's whatever it might be, right? And generally what happens in boardrooms is you have the finance committee where they consider their mission to be maximize return, period, the end. Then you have the programmatic part of the board where they see their part of is that we maximize our
Right.
community impact, right, our mission. And if you talk to the finance committee about reducing some of their potential return to move towards mission, a lot of times their response from the trustees is that by maximizing the financial return, we're increasing the value available to do the other work, but it's very bifurcated. And the reason is because in the finance committee, you can measure return.
Exactly. No,
Right here to the end. And it's hard to measure if when you start blending the two, even though you can convince them that, look, our overall return is really the impact, and the financial return is a piece. You can't blend these two measures. And you can't say it's worth trading off, 50 basis points of return to get some unmeasurable return in mission. And if you could blend those return numbers, then I think you'd have every foundation on board, but you can't do it.
and I know the H.P. Heron Foundation is leading this, and Clara put out a 21st Century Foundation report which explains their logic. So I think if they're a place to learn from, but obviously you've got your own challenges in terms of the various committees. But I think, I don't want to control it.
And every foundation is different, both in their size and their resources and what their mission is, which is why this is an important conversation for a board to have, just as we had that conversation when we developed investment policy for what's my risk tolerance and my asset allocation and what types of things should we allow or not allow. This should be part of that conversation about, and what is our mission? Are there things we can do that align with that mission? And I have seen no one, it doesn't mean there wasn't somebody that said, we're going to sell all of our investments and start all over as an impact investor. Typically what happens is people kind of move into it, and I think our investment policy language says, as we terminate a manager, one of the search criteria will be, returns, track record, all the things you look at, but given everything being equal, if they're an impact investing firm, that will tip the scale.
Yeah.
And nothing's ever equal, they're always close calls. We do have a lot of resources and intellectual resources on this. We'll talk more about that, that we will make available to any of you. So portfolio construction is important in that, portfolio has to be constructed anyway to try to minimize risk, have a broad diversity of assets in it that do different things at different times. We all have a responsibility as trustees and directors and committee members to have a return over a period of time that exceeds what we're paying out for grants, your expenses in managing the portfolio, and then something that covers inflation. Because whatever it is you support today will cost more to support 10 years from now, 15, 20 years from now. I read a white paper called The Delicate Balance that talks about that. If anyone would like a copy, I can send that. So how do you get there? There are a lot of different ways to do this. When the Pope came through the country last year, he made some very specific remarks about Catholic organizations making an impact on climate change. So there are faith-based investment solution managers who run for Baptist values, for Catholic values, for other types of values, or managers that manage with Sharia criteria. Environmental investing, if you're an environmental foundation, this is obviously very important. And then mission-aligned investments. Now, this is an example.
Can I ask a
this is a
question?
portfolio put together. Yes.
So one like the Catholic Church could really begin to sway the impact of how a portfolio is doing, couldn't they?
Absolutely.
Because of the billions of dollars and trillions probably, I don't know. But I'm just thinking if the Catholic Church, somebody big like that, is beginning to invest in more environmentally conscious activity,
Well,
wouldn't that begin to sway the performance of the...
Well, I mean, you make a good point that when a lot of money starts moving in one direction, that's what drives the market.
Right.
We track flows of retail investors into bond funds and stock funds, and when it's flowing out, it's typically after markets done poorly, then they fall out and then they go back in. So from a macro trend,
Right.
If a lot of money starts moving in this direction, those companies that meet those criteria are likely to do better as an investment just because there's money.
Right. It's just like locally when we started investing in cancer support community, all of a sudden all these other funders started coming to the table to support them. It's
Right.
just kind of a
And you know, what we're seeing is
momentum
it's
builder.
becoming a bigger trend.
Yeah.
So, okay, so here's the portfolio. I don't know if you can see it, but probably should have handed it out. It was recently put together for a new organization that wanted this type of thing. And the top 3 managers here all invest in companies that have high ESG standards according to KLD. So if you look at the second page of your handout, this is a report that one of these management firms does that says, let's look at your current portfolio, let's look at the S&P 500, and then here's our portfolio as to what the ESG ratings of the companies in that portfolio is. So you can see they're much higher than everything else, and then clean energy was a specific criteria this organization wanted. And so what is the clean energy criteria in that portfolio? So you can see that they're managing to very specific criteria. 15 companies have ranked higher on some things than others. If you go back to the first page of this, the impact monitor, you can see that some of these criteria, what the portfolio manager is looking for is they're neutral on environmental scores, biodiversity, climate change, they're a little bit higher, social access to service, community relations are pretty neutral, governance, neutral, balanced board of directors, and there's one of the things they're looking for is more balance. And then on the right side, they don't want any companies that have corruption violations, employee health and safety incidents, genetically modified organisms, human rights violations. So they're making sure the companies in their portfolios have none of those things. Okay, now that alone may make it a more low risk type of investment because you know, you're avoiding the potential blow-ups from some of those things. So let me come down this. There are a couple of international managers there. It's a little bit harder to get the impact exposure, I think, although one of them that I use all the time when I call them and ask them about this, they said, we'll send you, or I think they had a 15-page report on how they look at sustainability and ESG considerations when they put their portfolio together. We come down a little bit, the CRA qualified ESG is a bond fund or bond manager, a separate counter fund, and in that fund you can specify, our job is to make an impact on life in Maricopa County, and we would like you to invest in a way consistent with that. And what this manager did was invested in 2 mortgage-backed bonds that provide mortgages on low and middle income housing in Maricopa County. So, you know, owning bonds is kind of a, you know, not a lot of ways to make impact, but in this case they can. As they add investments to that portfolio, it will very specifically look at things being done, mortgage-backed securities in Maricopa County. The one under it, Breckenridge Intermediate Fixed Income ESG, is a portfolio that buys both taxable and non-taxable bonds. And we're seeing a lot of communities now sell these, quote, green bonds, where they sell a bond to finance a playground at a school or a playground or a new park or a water treatment facility. And so they are managing that portfolio very specifically to buy those types of impact bonds. So there are a lot of different ways to kind of get around this. So how do you get started? I think you have the conversation with your board, as Suzanne and Roy have with their board. You know, is this important to us? How important is it to us? What is the impact we want to have with our grant making? And, you know, that's always a valuable conversation that I'm sure every one of your boards have had, but not bad to revisit. And then is there a way that we can align our investments to that impact we're trying to have by investing in our community, by possibly, if we're worried about climate change and the environment, investing in companies that have a positive attitude and impact on that, companies that are developing solar power, wind power, companies like Tesla that are electric vehicles, and then integrate that into your investment policy statement. implementation strategy. So in the case of, well, as we terminate managers or as we go from long-term bonds because we believe interest rates are going to go up and they'll be negatively impacted, and we move to shorter-term bonds, is there a shorter-term bond manager that can provide green bonds or some of these other things that we're doing? And then, like anything in your investment policy statement, you need to reevaluate that annually at least. You may not change it every year, but have that conversation. But I think conversation about how impact investing fits into what we do is becoming a more common conversation today. So institutions, do you have the understanding of how your portfolio relates to your mission? What challenges are you hoping to solve through the organization? And do you have a mission-aligned investment statement? And then again, we have a lot of articles, white papers, and things that may define some of this more. So if you'd like to give me your card, I'm glad to send you some things like that. We're updating it all the time. So that is all of my.
So talk about the ones we invested in that was for the housing in Mesa.
Yeah, it was community capital management, and it was in that portfolio. It's called a CRA investment portfolio, and that was one where we said, we would like our job, our mission is to improve life in Maricopa County, and they invested in 2 mortgage-backed securities that provided mortgages for low-income and middle-income housing projects here in the county. And we'll continue to look at those as those bond issues come out. I'm sure we'll see more and more of them show up in the portfolio, but they can do that very selectively for an organization. They have a mutual fund where they're able to kind of target, depending on the investor investments in that area. It could be Arizona, it could be the county, it could be the Southwest, whatever your kind of footprint is.
And who's they, when you say they have a mutual fund?
Community capital management. So I'll put in a plug for them too. So for foundations that are looking for a very easy entry point, and it's bonds, so it's more controllable than like trying to develop a diversified portfolio. So what community capital management does, they came out of the Community Reinvestment Act, so they used to invest for banks.
Right.
And because of that, they have a platform that allows you to come on board and you can select where you want your impact, both geographically and thematically. So we can pick, we are focused on Arizona and we are focused on health. So they have the various thematic categories you can check off. And then the beauty of it is they will find opportunities that meet your criteria, but the return that you receive is not based on those investments. It's based on a mutual fund. So they're doing this for hundreds of organizations, foundations, and banks across the United States. And the reason, so they're creating a diversified portfolio of investments that cover the country, and all the investors get the mutual fund return, but you actually get credit for the investments in your geographic and thematic areas. And the reason they grew up this way is because the banks need to take that, they need to have attribution of their investments so that they can show that they're compliant under the CRA. But it works for foundations because I get a report every quarter of what investments they've made in Arizona in my thematic areas that's attributable only to me. And then I can say, these are the investments that are made because of my investment in this mutual fund and how it's impacted the local community.
What do your returns look like? You're starting, but what are they?
They've been very
competitive on how to get it back up.
We would have invested in it if it was a competitive return. So we actually
wanted both.
This, by the way, is kind of an intermediate term fund, and part of the logic here was as interest rates rise, whenever that is, long-term bonds will suffer because prices will drop, and we want to shorten up the maturities in the portfolio. So it's the right place to be from economic investment standpoint, but this is just a little side benefit.
I ran this over time. I went back 10 years and ran it in direct competition to a fixed income investment we had with PIMCO Total Return. And over the time frame I selected, I think it was within 12 basis points.
Nice.
But And then, and actually at that point when I ran the initial analysis, PIMCO actually was ahead by 12 basis points, but then following the collapse and everything, then we would have been much better off actually being in community capital management. So it's a virtual tie with my other bond investments.
Cool. And then we did invest in one that did international, but only because it had the returns we were looking for.
Right.
So the board had said, all things being equal, we care less about doing international than local. So this is where the capital management was so strong for our board. But Norm had proposed doing another one that actually, because like the Nigeria, because some of these third world, they have really good investments because there's so much need and it grows, it has substantial growth. So we ended up investing in that, not because of the social impact, although we said that's a good secondary benefit, but because it had the return we were looking for.
Was that a bond as well?
That was a private equity, very liquid transaction. A lot of foundations will make an allocation in the portfolio of private equity with the idea that we're going to give up liquidity in the portfolio. They're going to call capital as they buy companies or whatever they do. And then as they sell those companies or the companies grow, we're going to get returns from the income. And when they sell a company, a capital gain. To give up that illiquidity, you need a premium of 3 to 6% above the liquid markets to do that. I mean, that's the target, of course. And so if you have a private equity allocation, this was, we thought, appropriate in that their record was they had very high returns above the liquid markets, but they also make impact by creating jobs. And it's easier to do that in the third world than it is here. I mean, it's hard to invest in a company here that's, going to create, I mean, they may create jobs in a community, but the two examples I showed are actually in that fund. So they're creating jobs or, eliminating the need for cans being built in Nigeria, using local resources. They've been very careful about making sure that company has environmental, social, and governance criteria around it. They are paying benefits to the employees, which is almost unheard of there. So we think about high returns, but at the same time, it's really having an impact in that community, and they'll invest in probably 10 or 12 different countries. Yes.
One question. When you invest internationally, aren't you exposed to potential currency risk and currency fluctuations?
Yeah. The question is, are you exposed to different currency risk? Yes, and they do have a way of hedging that and taking some of that risk on. For a long period of time, it probably doesn't matter, but you're going to have the dollar moved up about 13% against the euro year before last, and that hurt a lot of U.S. companies because their goods were less competitive. For a long period of time, the dollar strength has been a benefit to investing in Europe and the emerging markets, but certainly hurt last year.
And you are subject to the risk, but also you have potential return on that as well. So hopefully you hire a manager that is selectively choosing to hedge risk or actually keep the exposure, because if currencies are moving the right way, it can really enhance your returns, right? So I expect my managers to be watching out for that, my international managers, and using that risk to generate return.
So you're in northern Nigeria rather than southern Nigeria, or the opposite, southern Nigeria rather than northern.
You also have political risk. I mean, you have a lot of things going on there. And they've tried to be very careful about that and making sure the funds they invest in have good governance. They're not, the companies aren't bribing people. I mean, it's what they call the third world.
Have you guys been in conversations with other foundations around the country? I mean, you're one of the few, I think, in Arizona that's actually thinking about impact investing and exploring it. But I wonder if there are other foundations that you draw from that in terms.
I mean, I've spoken and drawn a lot of information from the Heron Foundation, of course, because they're kind of a leader foundation-wise. And then.
But the Global Impact Investing Network, so there's the international.
And Jin,
Yeah.
And they're really working on trying to develop metrics around this, right? Because it's very hard to analyze what your returns are and present that to your board.
It's still so new.
Well, and I had the same thing that Norm's had that when I was at Council on Foundations last year. Every impact investing program, which there were like 5 or 6, was full. It was sort of standing room only. So lots of people are lots of conversation, even if they're not, and they're sort of at different stages of the conversation. So we said we wanted to have and continue this conversation with our, at least Audit and Finance Committee, and then we've been reporting to the full board. And the Audit and Finance Committee's been conservative, but still moving in the direction, yeah.
Conservative thought, I mean, a lot of lessons, I think, really, in that when this private equity investment, for instance, we presented that to the committee, very excited about it because of the social impact. And the response from the finance committee was, great, how did it perform? I mean, perform. It served no interest in them. It was not a compelling argument, which is very interesting, right? So, and not a wrong argument. They're looking for impact for Violence Health Foundation. Well, our impact, based on our mission, is focused on Arizona. It's not focused on an African country, right? So it may be great, but it's not a compelling argument for them to make an investment.
Unless the returns are comparable to the market.
Right.
Yeah.
So
we
I would
said
say they're
more
not wrong.
my vote.
And they had done 3 prior funds, people running a team from World Bank's for-profit arm, and they'd done 3 prior funds that had returns in the high teens. So it seemed like a good trade-off. At the same time, I speak a lot of conferences. I always attend them also. I'm always in all the rooms trying to find out what's going on. So, as I've talked to people at those conferences and our clients across the country, we've just seen a growing interest in this. And it tends to be gradual with an organization. I think it's gradual across the foundation space. So, but clearly a lot of interest. When we terminate a manager sometimes because they've had key people leave or something, I'll say we need to terminate them sooner than later, because if you have somebody that is managing $25 billion and all their clients start leaving them, they own 50 or 60 stocks, there's constant pressure selling those stocks that is going to have a negative impact on the return. On kind of a bigger scale, if money starts moving into the ESG area, you're going to have positive pressure on those stocks and those companies that are doing things the right way, which I think is why more managers are coming into the business, and B, why more companies are saying, if this trend is there, and if they're looking for companies that have positive environmental, social, and governance criteria, we better get on the bandwagon.
Yeah.
I think John has a question, but John, maybe to.
Yeah.
And I think you're muted. So he has his mute on. Hey, John, can you have your mute on? I can see on the screen. Can you turn that off?
Is that better? I'm going to get an echo, so I'm going to turn off my phone here. Hold on. How's that?
Great.
Can you hear me okay?
Yeah.
Is that all right? Okay. So I was just curious about, it sounds like it could take some heavy lifting to get them to shift on the equity side or the traditional investment side, but what about other things like cash management or the fixed income side of the portfolio, where you might be able to do some things like utilize a CDFI institution for cash, or for, or maybe there's a local intermediary that has a loan fund. There's some of is that included in this bucket, or am I talking about something completely different?
Well, I think it's included in the bucket. Case management, I'm not aware of anything like that. There may be a community bank, something. So that intermediate market.
He can, he can hear you. I just muted him so I don't get feedback.
Oh, okay. In cash management, there may be some local banks doing that where it's being reinvested in the community. Not aware of that. In the intermediate, short and intermediate bond space, it's easier with some of these mortgage-backed bonds and managers to do that very specifically. It's probably some baby steps, but I'm not really aware of anyone doing cash management on an impact basis, because they're buying treasury bills and short-term bonds generally.
All right, thank you.
Other questions?
Well, thank you
Thank you.
for being here.
Thank you,
All of
Warren.
If you need any other information, let me know, and I'd be glad to send it to you.
Excellent. Very, very interesting. We have a small token of our appreciation for your taking time. Thank you very much. And
So in our perfect world, we would have the audit or whatever finance committee other boards have put together talking about how we do this. I don't know how we make that happen, but that would be
Right.
sort of an interesting
An
opportunity.
affinity group, for,
Well, the finance directors finance officers of a number of the boards meet regularly, but there's no place where the finance-related trustees meet. So I don't know how we make that happen, but that would be an interesting.
It's not just an interesting conversation on how you implement impact investing. I think really with the trustees, we need to start back a step, which is what is our responsibility
Yeah.
revolving around impact investing. That general conversation, how far does that extend and what does that mean to the foundations?
By the way, if you look at the slide I had with all the different managers in that portfolio, I didn't really point it out, but at the bottom, that portfolio had done better for 3 years, 5 years, 7 and 10 years than its weighted benchmark.
Did we get those slides?
Yeah, I'd like that particular one for sure.
we'll send the slides out and we're sending the recording so everyone watch.
I know the ACF Finance Committee has had, because Steve's talked about it. I don't know, Mary, has your board?
I don't necessarily sit in on all those, but
Yeah.
no, it's not my impression that that's. Yeah, it's pretty traditional.
Is that probably because even though possibly the returns might be lower, but the risks are also lower? In terms of some of the portfolio. Is that possibly why the overall,
Why it's not more widespread,
Yeah,
why
I
it's just
think-
an emerging trend.
And most finance committees were focused on return. They should be focused at risk. I think they are, but it's kind of set. The balance is what's important there. But, I think if people are thinking, we're going to give up a return to do that, we're not even going to have a conversation problem. But I think there's ample evidence that you're not necessarily giving up return to do it. And you may be reducing the risk also.
All right.
Thank you.
Thank you.
Nice meeting you.